Trade wars rarely change overnight. Most unfold gradually through negotiations, official statements, and fresh tariffs that arrive so often Wall Street barely reacts anymore. But this time was different. A single decision shattered a pattern financial markets had trusted for years. When Donald Trump intensified pressure on Canada, he wasn't simply adjusting trade policy. He was challenging assumptions investors and financial institutions had long accepted as unshakable. In Washington, stability is often mistaken for control, and that illusion survived until Canada responded in a way almost nobody had anticipated. By the time investors realized the rules had changed, the first wave had already swept through the financial system. It all began with what looked like another routine escalation. Washington adopted a tougher tone, introduced stricter trade demands, and presented them as final conditions. The strategy seemed familiar. Apply enough pressure, force negotiations, extract concessions, and eventually bring the dispute to a conclusion on American terms. But markets don't respond to intentions. They respond to structure. And this time, the structure changed because Canada refused to behave the way every financial model expected. In Ottawa, Mark Carney wasn't reacting to Trump's announcement itself. He was responding to the assumption behind it, the belief that Canada would follow the same predictable path it always had. Tariffs would trigger counter-tariffs. Public statements would lead to diplomatic talks. Negotiations would drag on until another compromise emerged. That familiar cycle had become the foundation of countless financial models. But this time, Canada stepped outside it. And at first, almost nothing appeared to happen. There were no dramatic announcements, no immediate retaliation, and no public confrontation suggesting the dispute was about to intensify, which was exactly why almost everyone failed to see what was already unfolding. For a brief period, even experienced analysts assumed this would unfold like every previous trade dispute. Heated rhetoric would dominate the headlines, tensions would gradually cool, and both sides would eventually return to negotiations. But then something unusual began appearing. Not in political headlines, but deep inside the financial markets. Bond traders noticed movements that didn't match broader economic conditions. Currency desks spotted coordinated shifts that couldn't be explained by ordinary market activity. Equity analysts began seeing pressure across multiple sectors without any obvious news driving it. Yet no single headline could explain what they were witnessing. Ironically, that silence became the first real warning. When financial markets begin moving before the story becomes clear, it often means the story is already unfolding behind the scenes. And behind the scenes, Canada's financial institutions were quietly moving into position. This wasn't political coordination carried out through speeches or press conferences. It was institutional coordination, the kind that happens when major financial organizations begin adjusting in the same direction without ever needing a public announcement. Pension funds, sovereign-linked capital, and heavily regulated financial institutions all started making changes that looked insignificant on their own. But together, those seemingly routine adjustments formed a recognizable pattern. At first, Wall Street dismissed it as temporary market noise, assuming it was simply another reaction to global uncertainty that would fade once Washington clarified its next move. Instead of calming the situation, however, the White House escalated it further. Trump's strategy assumed that applying more pressure would restore control over the negotiations. In reality, every new escalation only accelerated the very process he believed he was containing because it continued to rely on one critical assumption that Canada would respond inside the same predictable framework it always had. This time, that assumption proved completely wrong. Mark Carney approached the situation from a very different perspective. Drawing on years of central banking experience, his focus wasn't on matching pressure with pressure, but on timing, coordination, and identifying exactly where the financial system was most vulnerable. The objective wasn't to react immediately. It was to wait until the consequences became impossible for everyone to ignore at the same moment. That's when Wall Street began sensing that something much larger was unfolding. The movement spreading across financial markets no longer looked like isolated reactions. They appeared increasingly synchronized. Even then, few people understood the full picture. Traders could see the effects but couldn't identify the cause. Analysts recognized unusual correlations without knowing who was driving them. Risk models detected anomalies but couldn't attribute them to any single actor. As the gap between the data and its explanation widened, uncertainty spread rapidly. By the time a coherent picture finally emerged, that Canada wasn't simply reacting, but executing a carefully coordinated financial strategy, the system was already well in motion, and perhaps the most important part of the story still hadn't become public. What Wall Street failed to realize was that everything it had witnessed so far was only the opening stage of a much larger sequence. Canada's response was never designed to happen all at once. It was built to unfold step by step. Investors believed they were watching another escalation in the trade dispute, but in reality, they had already entered Canada's response long before they realized it. Financial markets rarely panic the moment something happens. They panic when they realize something important has been unfolding long before anyone noticed it. By the time traders understood that Canada's actions weren't isolated decisions but part of a coordinated strategy, the second phase was already moving through the financial system. Meanwhile, Washington continued operating under the assumption that increasing pressure would eventually force a predictable response. More tariffs, tighter restrictions, stronger public statements, and tougher private negotiations all followed a familiar American strategy. Apply pressure, wait for the other side to adjust, then negotiate from a position of strength. But this time, the expected adjustment never came. Instead, the distortions across financial markets became even more pronounced. Credit pricing between American and Canadian institutions began widening in ways that couldn't be explained by economic fundamentals alone. Energy-linked derivatives showed unusual hedging activity, while cross-border capital flows, normally stable even during periods of political tension, quietly began shifting through alternative institutional channels. None of these developments appeared in official statements, making them even harder for analysts to interpret. In financial markets, when prices begin moving without a clear public narrative, risk is often mispriced long before anyone realizes it. Mark Carney's influence during this stage wasn't visible through speeches or political messaging. It emerged through institutional behavior. Central bankers rarely think in terms of headlines. They think in terms of calibration, small adjustments across massive financial systems that, when aligned, create powerful directional pressure without requiring dramatic public announcements. That was exactly what many on Wall Street failed to recognize. They were still waiting for a headline event, another tariff announcement, a legal filing, an official retaliation, something obvious that could be priced as a single shock. But by the time they realized no such headline was coming, the real story had already moved far ahead of them. But what was unfolding wasn't one dramatic event. It was a series of coordinated adjustments unfolding across multiple institutions. Inside Canada's financial system, pension funds, regulated institutions, and other major financial players no longer appeared to be acting independently. Instead, they seemed to be moving as different parts of the same stabilizing framework. On their own, each action looked routine: portfolio adjustments, liquidity management, standard geopolitical risk responses. But together, they formed a clear directional shift that Wall Street could no longer ignore. That was the moment confidence in the existing financial models began to crack. Most forecasts had assumed Canada would respond primarily through government policy. Instead, markets were witnessing something far more complex, a response emerging from the financial system itself. Washington, however, continued believing the dispute remained within a familiar cycle of escalation. President Trump's public messaging stayed focused on the same objective: maintain pressure until Canada complied. The message never changed, even as the system being targeted had already stopped behaving in predictable ways. That disconnect created a widening gap, and financial markets rarely leave gaps unfilled. They close them through repricing. By the time major trading desks in New York completed a second round of analysis, a very different conclusion was beginning to emerge. Canada's response no longer looked improvised. It appeared pre-structured, designed before the latest escalation rather than created in reaction to it. That realization completely changed the meaning of every unusual market movement that had already taken place. If those developments weren't spontaneous reactions but part of an existing framework, then the strategy hadn't been invented in response to Washington's actions. It had already been activated. Suddenly, the central question on Wall Street changed. Instead of asking what Canada would do next, analysts began wondering how much of the strategy had already been set in motion before anyone realized what they were actually witnessing. The moment everything truly changed wasn't marked by a breaking headline, a dramatic policy announcement, or the sudden collapse of a single market. It happened far more quietly, and for Wall Street, far more unsettlingly. By this stage, markets had stopped reacting in isolated bursts. Instead, different sectors were beginning to move with remarkable consistency, as though they were following the same underlying rhythm. Meanwhile, Washington believed it had reached the strongest point of its negotiating strategy. President Trump continued reinforcing the message that sustained American pressure would eventually force Canada into either making concessions or openly resisting. From a political perspective, either outcome could be presented as a victory, but neither happened. Canada didn't respond with matching statements, mirror image tariffs, or the kind of retaliation analysts had spent years modeling. Instead of concentrating its response into one dramatic action, it spread it across time, institutions, and multiple layers of the financial system, making it extraordinarily difficult for Wall Street to interpret in real time. Financial markets are built to connect scattered signals into a single, coherent story. Without that story, unusual movements often look like random noise until they become too widespread to ignore. And by the time that tipping point finally arrived, the changes had already become deeply embedded across the system. The pattern soon became impossible to ignore. In fixed income markets, the pressure was no longer limited to individual maturities. It began reshaping expectations across the entire yield curve. Equity markets experienced sector rotations that normally required major news events, yet no obvious catalyst ever appeared. Currency traders increasingly based their positions not on official statements, but on where they believed long-term capital flows were heading. Beneath all of these developments lay the same underlying signal: synchronized movement without a single formal announcement. Inside Canada's financial system, the coordination that had been quietly taking shape was now operating at full strength. This wasn't one dramatic intervention or a single extraordinary transaction. It was a sustained, multi-layered framework in which every adjustment reinforced the next. That was the detail many analysts had overlooked. This was no longer about one trade or one market decision. It had evolved into a broader systemic shift. And once a system enters a new state, it no longer behaves like a collection of isolated trades. It begins moving as an integrated whole. Washington, however, continued expecting the familiar cycle to return. The assumption remained that sustained pressure would eventually reopen negotiations and pull Canada back into the usual bargaining process, where both sides could adjust the terms and declare political victories. But Canada wasn't moving back toward that framework. It was quietly moving beyond it. That distinction became increasingly clear inside research departments across major financial institutions. Analysts who had once viewed the dispute as a routine trade escalation were now reaching a very different conclusion. Traditional models could no longer explain what they were seeing because those models relied on one core assumption: when one side increases pressure, the other responds in roughly equal fashion. Instead, the data pointed towards something far less conventional. While Washington continued escalating through political pressure, Canada appeared to be operating through a financial architecture capable of adjusting timing, exposure, and capital flows without waiting for political approval. As that interpretation gained traction, the central question on Wall Street changed once again. The focus was no longer on what Canada would do in response to Trump's latest move. Instead, analysts began asking how long this underlying framework had already been in place before Washington's latest escalation ever occurred. The coordination unfolding across the markets didn't look like improvisation under pressure. It looked like a system waiting for the right conditions to activate. What Wall Street was witnessing was never a collection of improvised reactions. It was the gradual activation of a strategy that had been prepared long in advance. As that realization spread through the financial community, the entire dispute stopped looking like a series of political responses and began to resemble a sequence that had been set in motion well before the latest escalation. From that perspective, President Trump's decision to intensify pressure no longer appeared to be the central event. Instead, it became the trigger that revealed a framework already waiting beneath the surface. By this stage, the line between politics and finance had almost disappeared. Every political statement coming out of Washington was quickly reflected in financial positioning, while every shift in the markets reshaped the political interpretation of the dispute. The two had become deeply intertwined, yet Washington continued projecting complete confidence. The administration still believed sustained pressure would eventually restore the traditional balance of the relationship, but Wall Street was beginning to understand something very different. Canada was no longer reacting to each new escalation as it happened. Instead, it appeared to be operating within a parallel financial framework that only became visible once all of its moving parts were working together. Looking back, many analysts concluded that Mark Carney's role was very different from the one portrayed in daily political coverage. Rather than simply responding to events, he seemed focused on aligning institutions in ways that required neither direct intervention nor dramatic public instructions. The objective wasn't to control every individual decision, but to ensure that once the right conditions emerged, the broader financial system would move in a coordinated direction on its own. That helps explain why the market reaction felt so unusual. It didn't resemble the sharp volatility that typically follows geopolitical headlines. Instead, it became increasingly synchronized. Bond markets, equity flows, currency positions, and cross-border capital movements all began shifting in ways that no longer appeared independent of one another. Rather than separate reactions to separate events, they looked like different pieces of the same sequence unfolding simultaneously across multiple markets. Once Wall Street recognized that pattern, something unusual happened. Instead of trying to predict the next political move, analysts began looking backward, attempting to reconstruct what had already taken place. The conclusions they gradually reached were unsettling. Liquidity shifts, the repricing of long-duration assets, synchronized institutional adjustments, and even the early Treasury-linked movements that first raised concerns no longer looked like spontaneous reactions to uncertainty. Individually, each development could still be explained away. Together, however, they pointed to preparation rather than improvisation. The system increasingly appeared to have been positioned long before political tensions crossed a critical threshold, and by now, that threshold had clearly been reached. Washington, meanwhile, continued viewing the situation through the familiar lens of negotiation. Wall Street had already moved beyond that stage. The question was no longer what might happen during the next round of talks. It had become something far more fundamental. What happens when the economic relationship between two countries no longer returns to its previous state after negotiations fail? That is an entirely different kind of risk. At that point, the debate is no longer about tariffs or trade policy. It becomes a question of economic architecture. Winning or losing a single dispute matters far less than recognizing that the relationship itself may already have been permanently reshaped. Rather than collapsing, the financial links between the two countries appeared to be quietly reorganizing in real time through coordinated institutional behavior that required no dramatic public announcement to be effective. That is what ultimately made this episode different from every previous round of trade tensions. For the first time, Wall Street wasn't simply watching a government respond to political pressure. It was watching a government operate within a financial framework that seemed to have anticipated the pressure before it ever arrived. By the time that realization spread across trading floors, research desks, and policy circles, the central debate had changed completely. The question was no longer whether Canada had responded effectively. It was whether Washington had realized soon enough that the assumptions guiding its strategy no longer matched the way the financial system was actually functioning. And by the time that question began circulating seriously, the markets had already delivered their verdict.